Welcome to the Stock Game Options 101. My name is Rico Lindsay, aka Rico's Way. I'm excited to be doing this. I'm excited to bring this course to you all because I always receive messages asking about options and, basically people trying to learn about it and how to really make money from it. Even people that's been in the game, they're looking to learn more. Like they're looking to learn what they should know about options. And I felt it was time. I wanted to make this more so like a conversation. I wanted to make it where you felt like you was directly asking me about options and I'm giving you the game. So, I was ready to get on video and do this for you all. I'm excited. Options has literally changed my life in so many different ways. I wish I knew this back when I first got introduced to the market. Matter of fact, let me jump back into how I even got into the market. About 10 years ago, one of my frat brothers, we was talking about the stock market. And he was basically telling me about how things work because at this time in college, like I was about to be heading out of college. I wanted to figure out ways that I can generate an additional source of income. I always thought about different ways of how to build a business, but I really wanted to get into the stock market, just by perception, I just felt like that's where all the rich guys were. So I really wanted to know more about it, So when he was telling me about it, he was just giving me the game. And I still didn't understand when he showed me how to buy a stock and, charts or what have you. I really was lost. But I started out, I bought a couple shares of Sirius Radio. I spent about $20. I think the shares was like $3 a piece or something like that. To let you know, I really wasn't ready for this game. I held them shares for all of a couple months and I sold it back and got my $20 back. And at this time, I was using what was known as Share Builder. They have now got bought out by E-Trade. So Share Builder is no more, but I really didn't know what I was doing. And I kind of just left it at that. Fast forward a couple years later, I wanted to give it a try again because I was like, I'm really trying to get into this thing now. I got a little bit older, I got a little money. So I'm really trying to figure it out. But at this period of time, I wasn't thinking about my situation and what I needed. So when I got into it, I came across some videos on YouTube talking about dividends and whatnot. And I was like, okay, this sounds like something that I want to do because I want to make passive income. So I thought dividends was going to be my route. But when I got into it, I realized fast for me to be successful with dividends, then I would need a lot of capital. So, of course, just the traditional way of grabbing some growth stocks as well. I got into that. I'm thinking like, I need to find something where it's going to make me a good sum of money I can put into dividends. So I was grabbing a couple of dividend stocks that a lot of dividend investors were getting into, and I grabbed a couple shares of Amazon. Now, at this time, Amazon was about $1,900. So I'm like, that's already crazy, Kate. And I don't know where Amazon is going to go. I'm just hearing people say, Amazon can continue to go up thousands of dollars, but I really wasn't in the game enough to know like what could potentially happen with my Amazon investment. So it was just whatever to me at that time. I grabbed some shares. I'm like, I'm gonna make some money off Amazon. And that was gonna be that. Long behold, I didn't realize and think about my situation at this period of time because I'm an entrepreneur. I have a clothing brand. So I needed that capital. I wasn't thinking through things. As an entrepreneur, it's always gonna be something that pops up where you're gonna need some money. You're gonna need to fund something. It could be marketing. It could be inventory. It could be anything. And you're going to need that money to do what's necessary in your business. And I wasn't thinking about that. So I had actually sold the Amazon shares for a loss because I'm like, man, I don't know when this thing is going to go. I need this money right now. I'm going to go ahead and get my money back because I need this capital right now. It's crazy to think about it now. Amazon is around like $3,300 now. So, I would have made some money, but, I needed that money. I needed that capital and I didn't have time to be waiting a couple years later. I needed that money right then and there. I needed my cash and I needed it now, so that just didn't work out for me. But I always kept that in mind with how that played out because I needed that cash flow. And I was just like, dang, like, I want to get into the stock market, but maybe it's not for me right now. Maybe this is not my lane until I get to where I need to go with my business and I can invest and not have to touch that money. Because if you're thinking about investments, you don't want to take your money out of a stock. Anytime you invest, I want you to be thinking 5, 10, 20 years from now. I don't want you to be thinking about a month-long investment. I want you to be thinking about compounding the money that goes into the investment, and allowing that to build up and become more over time. And I just wasn't ready for that. I didn't know when I was going to get back into the market, so I chilled out. I want to say about 2 years later, around the time of this pandemic, I moved to LA. I wanted to give my brand a real shot at reaching its potential. I knew LA was the perfect place to be for a clothing brand. And I moved out here, things was well, it felt like this was the right place to be. Couple months later after moving, pandemic hits. I'm like, oh man, my luck of moving here, being where I felt like I needed to be. And then a pandemic hits and I have a clothing brand. Like, I need people outside. I need people wearing clothes. I was like, yo, this is about to get crazy. So sales was still doing fine because I had a good marketing campaign on Facebook and the ads were doing well. But I knew I was going to run into struggles later down the line because this was still fresh. I didn't know how long we were going to be on lockdown. So I'm just thinking at this time, like, man, I need something else to shake. And then I came across this guy's Instagram where he was selling his course. But when he was selling his course, he was showing, a lot of different people that took his course and joined his group. He was showing the gains they made through options. I'm like, hold on. What is this options thing? Because I had Robinhood and I was like, yo, for the money I put in, I for sure wasn't seeing these returns that they seen, off of putting $100, $200, $300 in and seeing the gains they were making. I was like, I need to know more about this options thing. Now, to backtrack, I did hear about options when I was learning more about dividends, but everything that I heard on YouTube was simply about the negative side of trading options. So I was like, I definitely don't want to get into something where I'm taking on this much risk and I could potentially lose all my money. So I really didn't even give it a chance. Like, it didn't even spark anything in my mind to even look at, or do any more due diligence on. So I just let it be. But when I seen those gains, and that's the important thing about seeing people win, a lot of people talk about that, but a person like me, I have to see somebody win. I have to see the gains. I have to see the money that's being made for it to pique my interest. You know what I mean? So when I seen that and I seen the gains that people were making, it definitely piqued my interest. I was like, yo, I need to know about this options thing. I'm about to buy this guy's course. I have to get in this thing and I have to get into it now because, I was looking for an additional source of income. So after I took his course and he broke everything down, I was like, whoa, you can make money on the upside and the downside. And you can make these type of returns like in a day, in 2 days, and a week, and a month. I was locked in from there because this is exactly what I was looking for from the get-go. Now, to backtrack to when I bought that Amazon, if I knew about options and I understood options and what to do with them, that was the perfect time for me to get into the game because I would have been able to capitalize off of Amazon in a major way with the capital that I had. And I really could have took off then, but I didn't know no better. I didn't know what to do. So, that kind of like took me out of the market. I was like, yo, this options thing, this is where I need to be. This is what I need to be doing. So from there, I just really locked in on this course and then I tried it out. And the first trade that I took was on United Airlines. And I ended up winning on United Airlines. Then I ended up taking another trade and I ended up winning off Nike. And my thought process at this time was like, I don't know what I'm doing, but if I actually got a win off of this thing, then it's no telling where I could take this. Like, if I don't know what I'm doing and I'm making money, just imagine where I'm going to take this thing when I do understand what I'm doing. So I pretty much just locked in from there. Now, it took me down a bumpy road because, Only thing I had to my belt was that course, YouTube, and a couple books that I came across. But I really didn't have no mentors or no group at this time or anything that could help me speed up the process of learning. And I didn't have a support group to keep me from making the mistakes that I made. So I really had to get it out the mud. I really had to fall and bump my head 1,000 times doing this thing. And that's where my journey began. And honestly, a lot of the experience I had is what got me to where I am today. With all that being said, I've seen how this thing has changed my life since I've started this journey and where I am now. And I want to be able to pass this information off to you and let you start your journey, let you make an additional source of income and really take your returns to the next level. Because what I do know is, as an entrepreneur, I haven't seen these type of returns in the same time frame. And I really don't know where you could, from sitting at a desk, from being in a bed, from being at your job, from, just being out and about, just on your phone and just, pressing a couple buttons, and making these type of returns. Now it's a lot that goes into it when it comes to understanding how to read charts and things of that nature. But it's like, you can do this from the comfort of your own home. You can make a lot of money from just chilling. Honestly, it's really just about learning this thing, understanding it, and understanding how to control your emotions. The emotional side is the biggest thing. But I'm going to do another one of these courses where I talk about a lot of strategy and a lot of things with emotions. But what you can expect out of this course is simply about learning the basics of options and everything you need to know. I feel like people need to understand what options is, how to use it, and how to make money from using it. That's going to be the focus of this course. I'm excited. This is a stock game, Options 101. Let's get into it. What is an option? An option is a contract between a buyer and a seller. It gives the buyer, the owner or holder of the option, the opportunity to buy or sell the underlying asset at a specific strike price prior to or on a specified date. Options can provide investors with more opportunities than traditional equity buy and sell strategies. What are the advantages and risks of options? Options are cost efficient with great leverage and power. An investor can obtain an option position similar to a stock position without actually trading the stocks themselves, but with much more volatility risk. Options are a popular way to hedge your positions. However, when not properly understood by investors, they may pose a high risk of loss. Options have the potential to deliver higher percentage returns than losses. This is very true. Now, the thing about, the leverage that you get the leverage of 100 shares when you grab an option contract. So when it comes to you using less, you can make more. That goes back to what I was telling y'all before. Like, I didn't know this. And if I would have understood this, I would have been able to use the capital that I put into Amazon to put into options, and it would have went a longer way. The thing about it is, I took a loss on Amazon, but without understanding how to trade options, it could have been a greater loss on Amazon if I would have chose to go the option way without understanding what I was doing. The reason why people talk about options the way they talk about options is because it's a risky game. And honestly, if you go into this thing thinking about it in a way of a casino, you definitely can lose a lot of money. And that's how people approach the game. They come into it and, they treat it like that, with a gambler's mentality. And you can't come into the game with a gambler's mentality. You got to understand this is a trading technique, and we are traders and we have to trade. We cannot just come in and just YOLO a lot of money into an options contract and look to get rich tomorrow. No, we have to come in with a plan and we have to execute. So if you don't understand how to trade options, you can lose a lot of money, especially buying the wrong contracts, buying certain strike prices out of the money and things of that nature that we're going to get into later in the course. So if you don't understand what you're doing, you can assume a lot of risk and lose a lot of money. But this is something that I need y'all to understand. You only can lose what you put up. So, you know, when you buy an options contract, you know, a naked call or a naked put, then, you know, the money that you buy, I mean, the money that you use to pay for that premium with, you'll see how much how much you're paying. And that's all you can risk. That's what, you know, can go to zero. So I tell people all the time, do not put up any type of money you're not willing to lose. You know, if you need that money, then it doesn't need to be in options. You need to use that for your livelihood. When you get into options, what you need to do is you need to think about this as your business. You know, you need to have startup money. So you need to put some money to the side where you can invest in your portfolio. And this is solely for options, solely for you to build, not something where you're going to have to, you know, get in the game, try to make some money and take it back out because you got to pay certain things. No, you need to be putting some money to the side where this is solely the money for you to trade options with. So, you know, you can understand, you know, how much you're putting up, how much you know, putting on the line, and you'll understand how much money you're risking. And it's not something that's going to really affect your livelihood. It's something that's solely for, you know, trading options. So, you know, that's what I recommend. Put you some startup money to the side and, you know, definitely learn as much as you can learn about this game before you get in it, you know, because I do not want y'all losing your money, because you can and you will if you don't come in this thing, you know, with the right mindset. So, you know, I just want y'all to understand there is a ton of risk. So, you know, make sure you're on point. Now, this is the fun part. You know, we're going to get into calls and puts. There are two types of options contracts, which are calls and puts. A call options give the buyer the right to buy the underlying security for a specified price and obliges the call seller to sell the underlying security at that price. A put options gives the buyer the right to sell the underlying security at a specified price and obliges the put seller to buy the underlying security at that price. Now, understand, you know, when I'm going over these things in this course, these are things you need to know because this is the point of options. But when you seeing me make these gains, you know, it's because what I'm doing is making money off capital gains. I'm not exercising the contract. Now, when you're exercising the contract, these are, you know, the stipulations that you're going by. But what I'm doing is I'm buying calls or I'm buying puts and I'm making capital gains and I'm letting my contracts grow in value, you know, and give me a profit. And then I'm selling them back to somebody that's in the market and I'm making my profit and I'm moving on to the next trade. So, you know, that's what we're doing. But I definitely want y'all to understand what a call is for and what a put is for, because, you know, with calls and puts, it is a great strategy if you're trying to, you know, if you're ready to invest in the market and you're looking to buy more shares or you're looking to sell your shares, you know, calls and puts are definitely a great strategy. For instance, you know, if it's a certain stock that you want to buy, you know, 100 shares at a cheaper price, then you definitely want to, you know, grab a call on something, you know, allow that stock to grow. Once that stock grows and you, let's say you bought a call at $100 and that stock grows to like 150. When you exercise that contract, now you're getting those shares at $100, and you know the stock has already went to 150. So as soon as you grab those 100 shares at $100, you're instantly in profit, you know, when you exercise that contract. So, you know, it's a great way to buy shares at a cheaper price. But like I said, what I'm doing is allowing my contracts to grow in value, where I'm selling them back to the market before the expiration date, and I'm making money off my capital gains, and you know, I'm moving on to the next next trade, but you're about to hear about the expiration date, the strike price, and all of that good stuff. But before we even get into that, when it comes to calls, I want y'all to think of calls and puts this type of way. You make money off of calls when the stock goes up. You make money off puts when the stock goes down. That's what I love about, options, because you really can catch any type of market move through the day, and it's a great way to leverage. Like if you trade in stocks, unless you're shorting that stock, the only way to make money is for that stock to go up. But if you're buying puts, then you can leverage your position. So if you already got a position where you got shares or you're trading certain stocks, you can grab a put if the stock is coming down and you can make money on the downside. So just remember, to make money on the upside, you want to buy a call, and to make money on the downside, you want to buy a put contract. What are the advantages and risks of options? Options provide a strategic alternative to investing in equity. There are many ways to use options to recreate synthetic positions. However, there are many risks associated with trading options, and we suggest to do a lot of research before trading options. Options trading entails significant risk and is not appropriate for all investors. Options investors can rapidly lose the entire value of their investment in a short period of time and incur permanent loss by their expiration date. This is all facts that I wanted to provide to y'all. I'm telling y'all right now, you have to do your research, because options isn't for everybody, period. It's not even about you actually being able to learn the information. It's more so about the emotions that you have in this game. And, if you're an emotional person, or if you're an impulsive person, if you're a gambler, those type of things will eat you up in the market. You literally have to change yourself, and change those toxic personality traits, when it comes to money, to be a successful options trader. Like I literally had to change a lot of things about my personality. I literally had to think about, when I first started that, Rico, you love gambling, now, do I get out of pocket sometimes? Yes. Am I going to put my livelihood on the line? No, but I do get out of pocket when it comes to gambling sometimes. So, I understood if I didn't get that in order, then I wasn't going to be a successful options trader, because it's so easy for you to think about it like this. All right, place your bets. Do you think Apple is going to go up? Get your calls. Do you think Apple is going to go down? Get your puts. Like it's easy to think about it in a sense of, gambling. So, it's different, personality traits that you have to get out of your system before you get into this, especially if you're emotional. Like if you don't like seeing your positions down, if you get emotional about that, sometimes you're going to cut positions at the wrong time and you're going to see that stock turn around and go up. If you got a call and you could have made money, but you cut because you are emotional instead of actually doing the technical analysis to see that you were supposed to stay in the position. So it's a lot of different things like that that's going to take you out of the game. But you definitely need to know what you're doing. You definitely need to know the things that I'm talking to y'all about today. You need to know, what is a call? What is a put? If you felt like the stock was going to go up, you definitely don't need to be buying no put, And if you felt like the stock was going to go down, you definitely don't need to be buying no call. So you need to know those simple things of what you're doing before you just jump into the game. All right. Now we're getting into the option contracts. And, the first thing I felt that you need to know is, what is a strike price? Now, the strike price is the predetermined price at which the option contract becomes exercisable. For calls, the underlying stock price exceeds the strike price. For puts, the underlying stock price falls below the strike price. So strike price. So you'll see when you're about to buy a contract, you know, we all say like, what's your strike price? Like, what call did you get? You know, if you felt like, let's say Apple, for instance, right? And we just doing hypothetical, you know, prices or whatever. Let's say Apple is at, you know, $95 and you felt like Apple was going to go to $100. Let's just say you felt like it was going to go to $100. Then, you know, $100, you can either choose the strike price of $95 or $100. So, you know, $100 is your strike price. You felt like Apple was going to be above $100. Now we're going to get into expiration date, so I don't want to get into that right now, but I'm going to go back to this. But your strike price right now is $100. So $100 is your strike price that you felt like Apple was going to be above by a specific expiration date. So that's, you know, where you want to be. Like on the put side, you know, if Apple was at $100 and you felt like it was going to be below 95, you can get a strike price of $100 or you can get a strike price of 95. You're basically getting a strike price of where you feel like the stock is going to go, you know? So if you feel like it's going to go up, you basically saying like it's going to be above 95 or it's going to be at 100, you're going to get $100 call or a $95 call. If you feel like it's going to go down, you're going to get $100 put or a $95 put. You know, the strike price is where you feel like the stock is going to go. And this is the expiration date, and we're going to jump back into that. Options carrying an expiration date, which specify the last day the option contract exists. Options allow buyers to exercise the rights at any time before and including the date of expiration. Any contracts owned that are at least 1 cent in the money at expiration will be automatically exercised. Those at or out of the money at expiration will expire. Now, when you're choosing that expiration date, this is crucial because, you know, this is why you need time when it comes to these options. You're basically saying when you get a call, like the stock is at 95, but I feel like Apple will be above $100 by, let's just say, December. Then you will get your expiration date. It may be like December 15th or something. So you're basically saying, I'm getting a call that I feel like Apple is going to go up. So I'm getting a $100 call with an expiration of December 15th. And Apple will be above $100 by December 15th. That's how the strike price and the expiration price work together. And if come to December 15th and the actual price of the stock of Apple is above, you know, your strike price, then you can exercise that contract. But, you know, like I said, we're looking to get capital gains. If the contract is in the money, it's better for us, you know, so we're looking for it to go above that expiration price, you know, and you need time. If you don't have time, and it doesn't go to where you put the actual strike price, and you don't have time, your expiration time is like we call them weeklies, then things can get ugly. And we're going to talk about that a little later. We're going to get into the Greeks. We're going to talk about theta. So you definitely need time when it comes to these options contracts, you know, for the stock to do what you felt like it was going to do by that specified time, you know, and that specified time is your expiration date. When that expiration date hits, and, you know, let's just say that contract is trash. Let's just say you down 80, 90%, which you shouldn't be. You should have the proper risk management where you should have cut that loss a long time ago. But let's just say you held on to it and you're down 70, 80, 90%. You know, when that expiration date hit, it's a wrap. You know, when that contract is gone, it's gone, you know. So what you're looking to do is sell before that expiration date gets there. Even if you have time, just because you have time doesn't mean you're supposed to be holding that contract, because that stock can very well turn around and it's a wrap. So you need to be looking to take your profits when you got a profitable contract. You'll see when you're in profit, but you need to be taking your profits, man. So, you know, just because you got time don't mean you're supposed to wait until the expiration date. Because a lot of people used to ask me that, like, do I supposed to wait and sell it? No. What you're looking to do is get the contract, let it grow in value, and sell it and make a profit. So like I said, this is a great way to buy shares, and it's a great way to sell your shares. So some people that do look into, exercising their contracts, but what we're doing, we're getting money on capital gains. So you want to keep that in mind. All right, now we're about to get into in, at, and out of the money and what that means. A call is in the money when the underlying stock price exceeds the strike price. A put is in the money when the underlying stock price falls below the strike price. Option buyers want the option contracts to be in the money. An option is at the money when the market price equals the strike price. An option is out of the money when it is not worth exercising. Option sellers want the option contracts to be out of the money. When an option contract is worth exercising, it is in the money. Now, this goes back to what I was saying with your strike price and your expiration date. When you got a strike price of $100, right? We're going back to that Apple example. If the actual stock price goes above your $100 call, now your call is in the money. And let's say you have a $95 put. Let's say Apple is falling. When it gets below that $95 strike price, now your put is in the money. Now, when it's equal and, close to the actual price of the stock, then the actual price of the stock is like kind of close to your strike price. Now you're at the money when it's like kind of equal. That's what they're talking about. That's when you're at the money. Now, grabbing an out of money to call is basically grabbing if Apple's stock is at $95, you grabbing it out of the money for like 110. It's out there. It's out of the money, and it won't be in the money until you go above 110. So if it's at 95, you got a 95 call. If the actual stock is at 95, then you're at the money. When it hits 96, you're in the money. If you got a strike that's 110, you're out of the money. You know what I'm saying? So you want the stock to be above whatever your strike price is. That's when the money is going to get better as far as your delta. That's when your theta is going to get better. Those dips are not going to hit your contract the way it tends to hit it, and we'll get into that as well. But you're always looking to be in the money. Now, can you make a lot of money being out of the money? Yes, you can make money on a contract as soon as you get in it. Just because it haven't hit the out of the money strike price doesn't mean that you can't make money right then and there. But you have to get the right entry. You still have to be on point with your entry of when you get in, because you need that stock going towards the actual strike price that you have. If you're out of the money, you need it to be going towards it, And even if you're in the money, you need that thing to continue to rise. Or if you got to put, you need it to continue to fall, But you can make money as soon as you get into the actual contract. You just need that stock going towards wherever you put your strike price, or you need it to continue to go up if you got calls, and you need it to continue to go down if you got puts. You'll be able to make money as soon as you get in there. The break-even point is at the point at which the investor neither makes nor loses money. For calls, the break-even is found by adding the strike price and the premium. For puts, the break-even is found by the strike price minus the premium. The great thing about a lot of these brokerages is you're going to be able to see the break-even price before you even buy the contract. They're going to tell you what the break-even price is. So, this is the way that you can do the math on your own, but you'll be able to see this break-even price. A lot of people ask about the break-even, so I just wanted to throw it in here and let everybody know what it means and how you can calculate it. But on these brokerages, you'll be able to see it. They'll tell you before you even buy the contract. Now, the Greeks, this is very important because this is how these contracts fluctuate. You'll see your money go up and then you'll see it come back down. These are the reasons for that. So options traders often refer to the delta, theta, vega, and gamma for their option positions. Collectively, these terms are known as the Greeks, and they provide a way to measure the risk and potential reward of an option position. Since conditions are constantly changing, the Greeks provide traders with a means of determining how sensitive a specific trade is to price and volatility fluctuations in the passage of time. Now, I'm going to get into the Greeks and I'm going to tell y'all which ones are important to me. Delta. The delta represents the rate of change between the options price and a dollar change in the underlying asset's price. Theta. Theta represents the rate of change between the option price and time, or time sensitivity, sometimes known as an option's time decay. Gamma. Gamma represents the rate of change between the option's delta and the underlying asset's price. Vega. Vega represents the rate of change between the option's value and the underlying asset's implied volatility. Now, gamma and the vega are important, but what's most important to me is the delta and the theta. And the reason being is because you're looking to find a good delta because you want to see how your money is going to multiply as that stock continue to rise if you got a call, or how your money is going to rise if you got to put when the stock goes down. So the delta will be able to tell you that. The higher the delta, the better. That's what you want to see. You want to see a high delta, and the more that contract is in the money, the better that delta will become. So you're looking to get in the money. You're looking for the stock to go to your strike price so you can get a better delta. Now with the theta, you're looking for a low theta because that's time decay. Time might be the most important thing when it comes to options. Like, you need time, period. Once you become a great trader, you can do weeklies, which the contracts are less because they're about to expire, and you can make a lot of money on weeklies, but you have to get the right entries. You have to get in at the right time before the stock makes certain moves, and you just got to be nice with it, man. And you got to be able to make emotional decisions to say, hey, this is a weekly, this is a risky contract. So soon as this stock has made this a profitable trade, then I need to be cashing out and taking my profits. So you need to keep that in mind when it comes to weekly contracts. But you're going to get a better theta if you give yourself time on that contract, because time decay, the less time you have, the worse your contract is going to get, and more it's going to lose value. It's going to lose value every single day that it gets closer to that expiration date. So you want to keep that in mind. And if the stock isn't doing what you need it to do when you get in that contract, theta is going to be the thing that causes it to lose value. So you definitely want to have a low theta, and you want to keep time in mind as you buy these contracts, man. Understand there is time decay. So you need time on them contracts if you want to play the game safely. All right, now we're about to get into volume, open interest, and implied volatility. Volume is the total number of option contracts bought and sold for the day for that particular strike price. Trading value on an option is relative to the volume of the underlying stock. Traders should compare high option volume to the stock's average daily volume for clues to its origin. When an option has high volume activity, it usually indicates that a major event is about to take place with the anticipation of a price jump or fall. Put buyers are hedging a potential downside risk for a stock that may sell off, or inexperienced options traders who buy cheap out of the money options for no specific reason or a strategy, which happens all the time. Now, I tell everybody, when you're looking to buy a contract, it's things that you want to check. And this is one of them. These three are literally the most important to me. You definitely want to check the volume. You want to make sure it's people there, because you got to have somebody to sell these contracts back to. And if it's no volume, it's not going to be anybody to sell to. So you need volume on them contracts. And a great thing about it is when you see high volume on them contracts, it's going to multiply your contract, for one. And for two, it's basically telling you they know something that I don't know. It's something that's about to happen. And that's why I was saying it's a major event where it's anticipation for a jump. A jump would be with you getting calls. You're looking for the stock to jump up. And with puts, you're looking for the stock to fall. But when you're seeing that value, it's somebody that knows something. And they're looking for that stock to drop below or go above that specific strike price, very soon. And like I said, a lot of these put buyers, they're using this to hedge their positions. If they're bullish on a specific stock, they want to hedge their positions where they still make money on the downside. They might still hold their positions for the stock to go where it needs to go, but understand these stocks fluctuate. So you're waiting for them to go where you need them to go. But in the meantime, I'm going to go ahead and get this money on the downside. You know what I'm saying? So I'm going to go ahead and hedge my position while I weather this storm, and make money on this downside. And a lot of these new traders are buying these crazy out of the money contracts that don't make no sense. If Apple is at $100, and you know how Apple moves, man, it's not about to go to 150 next week, man. You don't need to be having no $150 strike price call contract. Come on, man. Let's be serious. You know what I mean? Like, so don't get any ridiculous out of the money contracts. Your mindset should be, do I truly believe the stock can go where the strike price has it at? Do I feel like it can go there? Don't be ridiculous when it comes to choosing your strike price, because you can get took out the game. But when you're seeing a lot of volume, it's usually a good indication. So you want to have actual traders in there where you can sell these contracts back to. So definitely look for high volume. Why open interest matters. Open interest indicates the total number of option contracts that are currently out there. It's one of the data fields on most option quote displays, yet many options traders ignore active contracts, which can lead to unforeseen consequences. One way to use open interest is to look at it relative to the volume of contracts traded. When the volume exceeds the existing open interest on a given day, it suggests that trading in that option is exceptionally high that day. So this is how you use volume and open interest together. You're looking for volume that's even higher than the open interest. That's going to be a good sign. You definitely want to have high open interest. You want to see what contracts out there. That's going to be another indicator that, hey, this strike price is a good one for me to have. Keep that in mind. That's going to tell you a lot of traders are looking at that contract, and you know there's some money to be made right there. So you're looking for high volume and high open interest. Implied volatility and how it affects options contracts. Implied volatility represents the expected volatility of a stock over the life of the option. As expectations change, option premiums react appropriately. Implied volatility is directly influenced by the supply and demand of the underlying options by the market's expectation of the share price's direction. As expectations rise or as demand for options increases, implied volatility will rise. Options that have high levels of implied volatility will result in high price option premiums. Now, implied volatility is so important to look at, period, because you can make a lot of money from IV and you can get hurt by IV. What you're looking to find when you get into a contract, please write this down. You're looking for low IV. You want to see it between 20 to, I'll say 60%. You're pushing it going to 70. You can go to 70, but you're pushing it. You want to see it from 20 to 70, because what you're looking to see is your implied volatility rise while you're in the contract. So your money will increase while you're in the contract. That's what's going to juice these contracts up and make them even more profitable. So you're looking to rise with implied volatility while you're in it. You don't want to be the person that buys a contract with high implied volatility and that stock goes left and that implied volatility goes down, and you just see the value of your contract just crash down. You know what I'm saying? You don't want to be that person that gets stuck in that scenario. So you want to be wary when you look at an options contract with high implied volatility, because that may be the indication to you that options contract has already made somebody some money and it wasn't you that day. So you need to just leave that alone. And another thing, when it comes to earnings dates, stay away from trading options. If you don't take anything from this course, stay away from gambling earnings dates with options, unless you just want to take the gamble and understand what could happen. Because if that stock doesn't move a lot the way you need it to move and grow the way you need it to go, if you got calls, it doesn't go up a lot, or if you got puts that don't drop a lot, then you will get hit with something called IV crush. You can lose a lot of money gambling earnings. So I want to make sure y'all understand that, man. Implied volatility gets really out of pocket around earnings time. So I don't even want y'all to take those risks. I don't even want y'all to play nothing through earnings. Just wait till the next day and take advantage of whatever happens, or understand that you are gambling going into it. It can go your way, but I'd rather y'all not even do it. Like, just stay away from it. It is what it is. Don't even do it. These are the rules to the game. This is my favorite part of it because I've already told you what you need to know. Though that's the textbook stuff. Like, you need to understand volume with buying a contract, open interest, implied volatility. You need to know what in the money, out the money, at the money mean. You need to know how to make money, calls if it goes up, puts if it goes down. But these are the rules to the game, man. This is how you're going to make money in this game, and this is how you're going to protect your money in this game. So number one, volatility is what you're looking for when it comes to making money with options. If you wouldn't buy the stock, do not buy the option. You need that stock to move either up or down. Now, when I got into the game, I didn't understand this. Like I told y'all, the first stock that I played was United Airlines, and the next one was Nike. However, Nike has been giving some significant moves lately, but Nike was not moving how it's been moving as of late. A lot of these stocks are slow moving stocks. Every stock isn't meant to be trying to day trade options on, man. You need volatility. You need these stocks to move, and you need them to move fast because you got time. You got time decay. I told y'all about theta. You got time decay. So you need these stocks to move fast. So volatility is what you're looking for. A thing that you want to do is in the mornings, you want to take a look at certain stocks. You want to take a look at their volume. You want to make sure it's a lot of volume on the stock. You want to see that traders are in it for that day and that stock is going to move for that day. So, volatility is what you're looking for, man. You're looking for that stock to move. I'm telling you, man, you don't want to get stuck in some BS that somebody told you to play because it's just like one of them stocks that sound good and that thing is not moving anywhere. You know what I'm saying? It's moving like a snail. That's not going to be no fun for an options trader. So trust me, volatility is what you want. You want to make money off of the pop. That's what you're looking for. You're looking for that stock to pop and move, and that's where you're going to make the money. Number two, conviction is everything when it comes to the market. You shouldn't be entering any contract without it. Before you decide to buy a contract, ask yourself, am I building or am I gambling? Please ask yourself that question before you get into these contracts, because like I was telling you, it's so easy to get into the gambler's mindset when it comes to options. It's a such thing as something called FOMO, fear of missing out. You don't even know why you get into it. Everybody just say, hey, grab a Tesla contract. And then you grab a Tesla contract and you're expecting it to go to the moon because everybody told you you're about to get rich. And next thing you know, you see Tesla crash for the day. And you're sad because you done lost all your money on that premium and you didn't do no due diligence. You had no business in that options contract. That's why you need conviction. You need to be doing your due diligence. You need to be doing your technical analysis and your fundamental analysis before you get into anything. You need conviction. You need a reason. You want to walk away from that trade, win or lose, feeling like, you know what? I did what was necessary. Either the market rewarded me for it or it just didn't go my way. But I definitely did my research. I did everything necessary to give me a shot at a profitable contract, and it just didn't go my way. But you want to have that conviction so you can feel good about each and every trade that you take in this market, because I'm telling y'all, man, you're going to do some nut shit. And I don't want to see y'all on that side of doing anything nutty. So I want y'all to make sure you have conviction on your plays. Please have conviction on your plays. Number three, do not be greedy. The profits that you make as an options trader can be taken away just as fast as they are made. So always take your profits. Now, I can't tell y'all how many times I had to learn the lesson of greed. Like, greed was smacking me up. I'm telling y'all, man. Majority of times where you're going to take an L is from you being greedy. I'm telling you right now, because you're going to see money come so fast and it's going to mess with you psychologically every single time, because you're going to be like, yo, how far can this go? Can I make more? Or you're going to be like, oh, well, it went here, so I'm going to wait for it to go back there because now I'm here. And then you're just going to see it just continue to go down. But I'm going to go ahead and tell y'all my first real encounter with greed. It was on Tesla. You know what I'm saying? Like, that's the crazy part. It was on Tesla. So I spent about $1,800 to $2,000. I can't remember exactly, but I had two different strike prices on Tesla cars, right? And I don't know what it was, but Tesla popped that morning. But I didn't expect this type of run. I didn't expect to see this type of money, right? Now, you know, I'm just seeing my portfolio start to go crazy, right? This was like my first big hit. So that morning, I saw my portfolio go to like 19,000, right? So I'm just going crazy that morning, like, oh man, like, oh man, 19,000, like, oh, you know, I'm hyped up, you know? Man, did I get greedy, right? So I'm sitting in at 19,000. I'm like, I ain't gonna snatch my bread right here, man. I'm trying to get to 20 times. I'm trying to run it up. So next thing you know, I see it go from 19 to 17. I'm like, oh, it's cool, it's cool. You know, we're gonna get back to 19 once, you know, Tesla pick back up. It's gonna continue to go. So I seen that thing go from 17 to 15. So when it goes to 15, I'm like, ah! Oh my gosh. I'm like, man, I just want to get back to 17. Man, it was at 15 for like, I want to say it was like an hour and some change. Next thing you know, I just start seeing that trade drop to 13, to 11, to 10. Now my portfolio was at 7,000. So I went from seeing 19 to 7. And all I had to my name was a screenshot showing my profits that I was up 15 as far as profit. So that's all I had to my name. I ended up closing out. My account was at 7,000. It was bittersweet because I'm like, man, I made a couple thousand, but my portfolio could have been up to 19,000 that day. And I was just showing the homies, and all I could say was, I seen 19,000. Man, that don't count. Unrealized gains don't count. If you get the screenshot, and that's when you take your profits. You screenshot, you take your profit. Because that day, I could have took my profits. And that took me through a long line of heartache, through being greed, you know, over the months, even after that play, just over being greedy. Rico, you're not going to be greedy. Then do it. Like, you're going to do it again until you master the mind. You have to master the mind. And you can't worry about what the stock could potentially do, only what it has already done. So if the stock has already made you money and ran or went your way, take your profits. Do not be greedy. You have to leave some money on the table, man. You can't make all the money in the market. You're going to be happier when you take your profits. Of course, you're going to be a little sick if you see that you left some money on the table, but I'd rather you leave some money on the table than to miss out on taking profits at the high or a good amount that you were really happy about. With my account at 19, I was really happy about that, but I did not take my profits, man. I had to learn a hard lesson about being greedy. So do not be greedy, y'all. Number 4, understand your personality traits, because that's going to be very important for your trading style. If you make a lot of impulse decisions, then you shouldn't take risky trades. This is what I was talking about earlier. The market is going to bring out all of those personality traits, all of them, man. It's going to bring out the ugly side because it's your emotions. You know what I'm saying? You got to think, a lot of us been emotional for 30 years. You know, I'm 33. You know, I've been emotional a long time. A lot of conditioning went into being emotional. Emotions and money don't mix, man. I'm telling y'all that right now. Emotions, money, and the market do not mix. So you got to understand your personality traits, and you got to be in control of those so you can make logical decisions when it comes to the trades that you're entering, the contracts you're buying, and how much money you're spending on those premiums. You know, you do not want to be YOLOing and going for the gusto because you're trying to get rich or you're trying to make your money back. Do not chase your money back. Do not revenge trade. Do not chase no money that you lost in this game back. I'm telling y'all, it's gone. Forget about it. Worry about the next trade. Worry about making a profitable trade the next time, because understand that losses come with the game and you do not want to make emotional decisions. So those traits of your personality that don't mix with money, you got to work on those. You got to get those out of your system, because I'm telling you, man, it's going to take you down a sad road. This was your warning. You know what I'm saying? Get those personality traits in order. Number 5, do not buy a premium for more than you're willing to lose. Understand that your contract can go to zero, so you should always be mindful about the amount of money you're investing into the market. Self-explanatory. Do not put up anything that'll change your livelihood. And the thing about it is, if you're willing to lose that money, you will make better emotional decisions. If it's like a crazy amount and you see yourself start to take a loss, you're not going to have proper risk management, because you're like, this is more than I was willing to lose. I'm not trying to lose this, and it will continue to get worse. But if it's money that you're okay with losing, you're going to cut at the right times. You're going to have the right risk management. You're going to think more sound when it's something you don't mind losing. Think about it. If it's a $40 loss, you can cut that. But it's a $400 loss, you're going to be thinking about that. Number 6, the trend is your friend. Attempting to predict market trends in advance can be extremely hard. So always trade what the market gives you. Every single day, trade what the market gives you, man. I don't care what history has told you. I'm telling you, man, this thing is unpredictable. It's so many things that we thought we was ahead of because we looked at history and things happened, but it didn't happen on our time. So it messed up a lot of trades for us, and we missed out on a lot of things, you know what I mean? So you want to make sure you follow that trend, you trade what the market gives you every single day, especially when it comes to choosing certain contracts and the times that you give it, because we already thought it was going to be a correction a long time ago. But think about those people that had SPY puts at 300 and something for like September, October, December, you know what I'm saying? Like, they thought the market was going to correct already and they was going to cash out. But you see, SPY has been on a tear, still going up. Yo, SPY is ridiculous. You got to be mindful, man. You can't predict everything, and you got to trade what the market gives you. All right. This is the most important rule to the game. Number 7, trade like a robot. You cannot have any emotions in the market, because this is going to be very crucial to making sure you secure your profits and protect your portfolio with a strong risk management strategy. I've been telling y'all the whole course, it's no emotions, and the market does not care about how you feel. If you want to be a successful options trader, you have to trade like a robot. You have to execute your plan every single day, whether that's with the right entries, as far as on the technical analysis side, the right exits on the technical analysis side. If you need to get out, the right risk management, making sure you cut your losses, make sure you take your profits. You have to trade like a robot every single day. You cannot think about anything. You feel me? So I want y'all to keep that in mind when it comes to this market every single day. Do not have no emotions. I swear the market does not care. It's always going to be a winner. And the winner is going to be the one that made the right decision and that executed this strategy. You always want to be on the right side of things. Of course, losses come with the game, but the goal is to win big and lose small. Lose small and win big. Understand that, and you will be on point, man. You're going to get to where you want to go. Make sure you trade like a robot, man. It's the most important rule to this game. My final thoughts, man. We done went through all of the textbook stuff. We done went through the rules of the game. My final thoughts is, like it says, a strong technical and fundamental analysis trader who trades like a robot will build a profitable portfolio. Period. If you got the technical side down and you're able to look at news, look at the success of a company, the logistics of a company, and you're able to keep your emotions intact, you're going to kill this game. You know what I'm saying? Period, point blank. It's a lot of technical guys and fundamental guys that can't get ahead in the game. Think about it. The majority of traders are not profitable. The reason is because the emotional side will take you out. So you got to be on point with all three things, because you can have the emotional side down packed, but not understand how to read charts, not understand how to find companies that's going to make certain moves. So you got to have the full package, man, to take it to the next level. So focus on becoming a strong technical analysis and fundamental analysis trader, and focus on making sure you got your emotions in check. So I definitely recommend everybody go get the book Trading in the Zone by Mark Douglas, so you can get those emotions on point and take this thing to the next level, man. I'm telling y'all, it's a lot of money to be made with options, man. I just had a crazy week. Crazy. I'm telling y'all, man, I had a crazy week, bro. I had hit for 30 bands off Tesla on Tesla puts 6 days ago. I looked, it was 6 days ago that I made the post on Instagram. And then on Friday, I made my biggest trade on Roku. I made $112,000, 100 bands overnight. Bought the contracts on Thursday, sold on Friday morning, bro. No cap. I'm about to log into my Weeble. I'm gonna go ahead and let y'all see. I'm logging. Hold on. Y'all can see that this is Weeble that I'm logging into. So y'all see, hold on. Cause I'm telling y'all, man. I'm telling y'all, this was a crazy month. Got September 24th. So y'all can see the date. Realized, I told y'all, we don't respect no unrealized, only realize the money that you took when you cashed those contracts out. That's all we care about. Realized $112,000 off of Roku. I know it might look a little backwards or something, but y'all see. $112,000, man. That's my biggest trade. I've been trading options for a little bit over a year. Man, and made these big strides and finally got my biggest trade, man. And, it's wild, man. It's wild, and the thing is, becoming a profitable trader is wild to me, because you hear all of these things like it can't happen. You hear, all of the statistics. But honestly, bro, I just fine-tune and reverse engineered the stuff that I was effing up on. You know what I'm saying? And I really had to understand options and the whole point of it. And the whole point is to get in the money. So I had to start choosing my contracts strategically and putting myself in a position where I can win more than I lose. You can become profitable with this game. After this course, you should understand it. You're going to make money with calls when the stock is going up, puts when it goes down. You got to worry about time, got to worry about the Greeks, got to worry about theta, with time decay. I told y'all how to choose the right contracts, look at volume, open interest, volatility. Now it's up to you with strategy. That's going to be my next joint. I'm going to drop a joint with strategy. I'm going to talk about, technical analysis, go through the indicators that I use and all of that good stuff. I'm going to do that for y'all. I'm going to give y'all this whole entire game, but I really had to give y'all the basics of options so you can understand what they are, how they're used, and how to make money using them. I hope y'all ready, man. I hope y'all ready. Watch this thing over and over and over. Look at the PowerPoints. Write everything down in your notes. I want y'all to get all of this information, man, so y'all can come in this game, y'all can get this money, and y'all can see y'all 100K day, because it's coming, I'm telling y'all. With all that being said, if you want to trade with me, you want to continue to build, once you understand options and things of that nature, come join my Discord, man. I got a lot of education tools in there. You can get those for free. So you can join for free. And when you're ready to trade with me, come join my Discord, Stock Market Moves. You know, I'm there 24/7. That's where you can find me. So, you know, I'm looking forward to y'all joining the community, man. It's a fire community. I just want to see y'all become profitable traders. So that's my thought process with everybody that's in there, man. I want to get everybody seeing 6 to 7 figure portfolios, man. That's the goal, man. So I definitely want to see y'all in Stock Market Moves. Come join. Like I said, it's more educational tools, books, you know, courses, all of that good stuff is in there for free. So come get access to it. You know, tap in with me in there. If you want to listen to me on Mondays, Wednesdays, and Fridays, I do market motivation in the mornings on Clubhouse. So come check me out on there. It's the Stock Market Moves Club on there as well. So make sure you join the club and listen into the game, man. Get fired up with your boy. I hope y'all enjoyed this course, the Stock Game Options 101. I'm excited for y'all to get y'all hands on this information. With all that being said, it's just time for you to apply the information and get this money in the market. Oh yeah, before I go, on your brokerages, when you're applying for options, you have to be on point with your answers because they're looking for people that's advanced traders to do options because it is risky. So make sure you answer those questions correctly. They're looking for advanced traders, but you have to apply for options. So, you know, keep that in mind. Go ahead and apply. And if you want to come to the game, go to Webull. I got a Webull account. You know, that's what I rock with. A lot of people like Thinkorswim. You know, a lot of new traders like Robinhood, but you know, but I encourage everybody to come over to Webull game, man. Get you a cash account, man, so you can trade unlimited on settled funds. That's what you're gonna have to do until you can get to that 25,000 and you can trade unlimited with no issues. You know, that's where you're trying to get to, but use that cash account to get there. You know what I'm saying? And you know, come over to Webull game, man. Any questions you got about this market, just holler at your boy. I'm open to giving you more information. Hit me up on all social media platforms at Rico's Way. I'm looking forward to seeing y'all growth. The Stock Game Options 101. The world is yours, man. And until next time, y'all enjoy your day.